What's up, everybody, and welcome to today's webinar. JKAM is dedicated to creating passive income and growth through private real estate opportunities, providing you with a better way to build wealth without Wall Street. We got to start first with a disclaimer, and this is being recorded, so if you want to read this in its entirety, you can review it at a later date. But essentially, this is not an opportunity to invest. You must first read the private placement memorandum and the subscription document, and this is only appropriate for accredited investors. So why JKAM? Well, it is our mission to connect our community to private alternative investments, providing exclusive access to a modern approach to creating wealth without Wall Street. Since inception, we have helped our community participate in 33 properties, totaling over 7,400 doors in 22 metro areas. Jack Krupe and I founded JKAM Investments. Jack has a dual MBA from Northwestern Kellogg School of Management and Hong Kong University of Science and Technology. He's been investing in both real estate and distressed debt since 2001. He has built long-term relationships with experienced real estate developers, sponsors, and syndicators over his 20-year career. Jack has leveraged the 2008 financial crisis as part of our private equity fund that yielded impressive returns off of distressed and restructured debt. He repositioned properties as well as modified and restructured loans for borrowers. And in 2014, Jack entered into a partnership with a large private equity fund and led the asset management arm of the firm that made over $3 billion in purchases of non-performing and reperforming mortgage debt between 2015 and 2019. As an entrepreneur by nature, Jack decided to start JK Asset Management to focus on alternative assets such as value-add multifamily real estate. He then launched the JKAM Diversified Real Estate Fund in September of 2020. Myself, I am William Benatti. I graduated from Colorado State University. I got a bachelor's in finance and real estate. I've been an entrepreneur since 1998. I have a broad background in business, including insurance, banking, financial services, real estate, alternative assets, and digital marketing. In 2014, I started Infinity Asset Ventures, LLC, which is a firm focused on investing in distressed residential single-family homes nationwide. In 2016, Infinity Asset Ventures acted as the exclusive dispositions trade desk for Jack's distressed private equity fund with a portfolio of over $3 billion in assets. And in 2020, I teamed up with longtime friend and colleague Jack, founder of JKAM Investments, to serve as partner in business development and marketing. So the JKAM's team is fully supported by professionals who know their stuff. We have relationships with firms including Strategic Fund Services, which does our fund accounting. We have third-party oversight through Verivest, which does things like background checks on principals and verifies fund holdings. Our legal is through Fisher Broyles. And finally, we have tech-forward investor portals through Avestor, for our direct offerings, and Syndication Pro for our diversified fund. These platforms allow our clients to view fund and project updates, all your tax documents, and all the fund and direct project documents as well. So the sponsor and operator of this opportunity is Lone Star Capital, and I'm excited to have joining us today Rob Beardlsey. Good afternoon, Rob. And thank you for taking the time to join us today. Can you share with us you and your team's background?
Yeah, absolutely. So my name is Rob Beardlsey. Myself and my business partner, Kent Petrikowski, are the founders of Lone Star Capital. We started Lone Star in early 2018 to focus on owning and operating Texas multifamily. To date, we've acquired over 2,000 units, primarily focused on Houston, but all of which is in Texas. We've also launched our own in-house property management company, Radiance Living, which is based in Houston, which has allowed us to vertically integrate our operations and be a lot more hands-on and transparent with our business plans and reporting. And it's something that we will plan to continue to do as we bring construction in-house this year as well.
Awesome. Great. Thanks for sharing. And like JKAM, beyond your core team, you also have relationships with trusted tax, insurance, legal, and accounting professionals whom contribute to your smooth deal execution, right?
Absolutely.
So looking here at Lone Star Capital's track record, maybe you can just touch on this high level for us.
Yeah. So as you look at this track record, you'll see, like I mentioned, we're very heavily invested in Houston. It's our main market. We're experts in the market. We have a great reputation there and strong relationships with brokers, owners, which allows us to get access to the best opportunities. We get first looks, we get last looks, and that's what allows us to really find the top 1% of deal flow. And moreover, because we're so active in a specialized location, we have great data and insight. And so we know what a 1% deal looks like. We're not shooting in the dark, and we're not just guessing that we think it's a great deal. We have the data to support it. And that gives us the confidence to identify and then go out and execute on these opportunities. So that's at a high level,
Yeah.
our pipeline. And yeah.
Yeah. Awesome. Thanks for sharing. Let's jump into the meat of this, right? Because I know I want to be considerate of everyone's time here. So we are here to share and talk about the Broadstone Briar Forest opportunity. Starting first with the investment overview. So some of the key investment details on this are JKAM and Lone Star Capital. We are pleased to present Broadstone Briar Forest, which is a 342 unit Class B multifamily value add investment opportunity in fast growing West Houston, Texas. The property was built in 1983 and has been well maintained. It had institutional ownership since 2006. It has a solid mix of units of one bedroom townhome with dens, 2-bedroom floor plans with an average size of 819 square feet at 1,014 in monthly rent. You guys, Lone Star, saw Broadstone first in fall of 2021 in a closely shopped process that did not result in a transaction. And through, as you said, being local and hanging around the hoop, I love that. You were able to secure this as an off-market deal at a 4.4% cap rate, avoiding the full marketing and costly bidding war. The property sits in a highly desirable residential area just around the corner from Ray Daly Elementary School and across the street from Village School, which is a $33,000 a year IB boarding school ranked as #2 in Texas by niche.com. The Yardi rent comps have seen a 14% rent growth in the past year, and future rent growth is projected at over 4% annually through 2025 for over $200 over the projected 3-year hold period. The property is ideally located off Westheimer, convenient to Houston's major job hubs downtown, while balancing affordability with family-friendly sheltered neighborhood. Nearby home values range from $300,000 to $700,000, and villas across the street are for sale for $400,000 to $480,000. And your purchase price on this, or acquisition price, is $48 million. Senior loan was $42 million. CapEx budget is $3.8 million, and you're expected to close on this on April 12th. Jumping forward to the business plan and financing, Rob, can you speak to the business plan and financing here?
Sure. So this property is, for its age, being a 1983 property, it's in great shape. So we're really pleased to see the results of our inspections. There's really minimal deferred maintenance. So there's a strong opportunity to build on that foundation and really spend capital on revenue generating items, such as finishing out the washer and dryer program. Currently 70% of the units have washer and dryers, and all the units have connections. So we're simply going to roll that out so that all the units have in-unit washer dryer. We'll also be building on the renovation plan that's already in place. About 60 units have been renovated to a new premium tier. So there's a big gap between the renovated units and the model unit versus all the majority of the occupied units. So the plan is to, upon lease expirations and move outs, we will turn over those units and push them to that new premium finish, and they'll go even a bit above and beyond by installing backsplashes in the kitchen and a tech package, which is a smart lock and a smart thermostat accessible by the tenants from their phones. So that will really give an additional lift to the property and also unify the interiors across the board. I always, residents never love to see a really nice model unit and then go and see the unit they're going to rent, and there's a big delta. That's even if there's a rent gap, that just is off-putting. So So that's some of the things that we're focusing on. There's also other ways that we'll be generating other revenue, which includes covered and reserved parking. The property currently has no covered or reserved parking, so we'll be implementing, we're budgeting for 60 spaces. And then we're also going to be expanding upon the private yard plan at the property. The current ownership has experimented with 30 yards on the ground floor by expanding the small backyard.
Mhm.
And they did a very minimal private yard with, you know, a low and just kind of iron fence. So it's not really private. And so we plan to actually build a nice tall wood fence, which is going to be enough space for a dog and provide the privacy. And residents will, you know, from our research, residents will really appreciate this and be willing to pay a premium for those ground floor private yards.
Yeah, okay, makes sense. So to be clear, there's 277 units that need to still be fully renovated. In those units that already have some renovation done, is there anything beyond washer and dryer that has to happen for those units? Is it?
It'll be the washer dryer, it'll be the tech package, and the backsplash in the kitchen.
Okay, gotcha. All right, so why don't you talk to us a little bit or share with us a little bit about the financing here?
We're acquiring this property with a traditional bridge loan, which has an initial term of 3 years with 2 one-year extension options for a total of 5 years of loan term. The interest rate on this loan is a spread of 3.4% over SOFR. SOFR today is at 5 basis points and is anticipated to increase as the Fed raises rates. So we've put the forecasted Fed rate increases into our underwriting. So we're already projecting the future path of rates, and that's already being accounted for in our cash flows.
Okay.
And the loan is funded at 80% of purchase price, and then we'll be drawing down our construction budget from the lender as well.
Okay. So can you give me some color on hold time? I mean, you look like it's 24 months to complete the renovations and amenity upgrades. And then 3 years is the goal, but is there anything beyond that we need to know?
Yeah. So to provide some color on that, every bridge loan acquisition we've exited from to date, we've done so in about 18 months. However, we're of course being conservative and projecting a 24-month timeline to implement our business plan. Upon stabilizing the property, we'll have the opportunity either to refinance out of the bridge loan in approximately 24 months or simply sell the asset at that time if market conditions are strong and we can exceed our investor returns. So the way I look at it is, you know, maybe the base case would be to stabilize as quickly as possible and sell in 24 to 36 months, or we would refi upon stabilization and then hold for probably 4 to 7 years total.
Okay. And some may look at the loan to cost, or, you know, at 80% there is, and say, that's a little on the high side. Can you speak to that?
Yeah, the idea behind that is the initial funding of the loan is at 80% of purchase price, right? So that's pretty standard, but then the additional construction draws are done as work is completed. So the idea is that as you complete work, you get funding from the lender, and then that increases the loan balance. And so if we're being judicious with our CapEx spend, we should be getting more than a dollar for dollar return on spend. So the leverage should actually be going lower as we implement the plan, because the value of the property is going up and up as we push revenue through our CapEx budget.
Yeah. So through that forced appreciation, the LTV should get better. Of note here is that Lone Star Capital is putting money into this project as well. So you guys do have skin in the game. I know that's super important to a lot of people, because you're participating in it, so you have you know, clear intentions to execute. So let's just jump forward here to the value enhancement plan. I know you touched on this on the last slide, but maybe you can walk through this again for us real quick.
Yep. So this is just a highlight of the plan that we touched on before. So I would say the biggest single thing we're doing is just the premium unit upgrades, right? There's the 65 units that have already been proving out that rental premium. And so we're going to do that across the board and take it a step further on both the already renovated units and the classic units. And then finishing out the washer dryer rollout, which will then allow us to have washer and dryers in all of the units. And from that, we'll be able to actually repurpose the laundry room into a pet spa, which is becoming a more popular amenity, and it'll be positioned right next to the dog park. So that'll be nice. And then as far as pushing other income, as we discussed, we've got the 60 private yards and the 60 covered and reserved parking spaces. And based on the success of those programs, we may choose to pursue them further and add more covered parking spaces or more private yards as much as the property allows.
Right. So you're doing those in phases.
Right. And then finally, the smart home package. The important thing to note about the smart home package is we actually budgeted to break even on the package. We're not, so in reality, we'll be pursuing a upcharge for the smart home package, an extra $25 a month or so. But in our model, we just wanted to be conservative, and we anticipated spending the capital for installation, but not making any profit on the program.
Yeah. Okay. Awesome. Thanks for sharing. So looking at the investment returns, this target IRR is 17.5, 1.59 equity multiple. Lone Star Capital is offering JKAM investors limited partnership interest in Broadstone Briar Forest. The limited partners receive a 9% preferred return paid monthly. Shortfalls in this pref payment will accrue and compound at the preferred rate of return or preferred return rate. Upon a capital event, investors are first entitled to their preferred return and then 100% of original capital. Thereafter, excess proceeds are split 70% to the LP and then 30% to GP. This is a highly competitive incentive structure and offers investors security and strong baseline returns while incentivizing the manager to maximize the value of the venture for all parties. So investors receive 100% of ongoing cash flow, as well as compounding 9% IRR-based preferred return above full return of initial investment before any performance incentive is paid to the sponsor. And this preferred return is cumulative and compounding rather than simple cash flow split, rather than a simple cash flow split often seen in other investments. There's a 2% acquisition fee, a 2% asset management fee. This is what the distribution waterfall looks like visually. First, investors receive any accrued but unpaid 9% pref. Second, investors receive 100% of their originally invested capital back. And then third, distributions over a 9% IRR are split 70-30 to the LP and GP. So that's distribution waterfall for Class B. Those participating through the JKAM opportunity are getting the Class B. So the distribution waterfall for Class A is not really relevant to anyone participating through JKAM. So moving on to the property overview. So can you speak to the current units? I mean, you've done this already. So, you've touched on all this, but here's some classic units, right? On the top.
Yeah, you can see pretty rare these days to find an untouched opportunity like this, where you've got the tile flooring, you've got the old cabinets, countertops. The appliances are mostly in good shape, so we'll be replacing those on an as-needed basis, which will allow us to hopefully be more efficient with our budget.
Mm-hmm.
And if you look down below at the bottom two pictures, so again, all these pictures are pictures of the actual property itself, mm-hmm. and the bottom two pictures are the model unit. So they've done a fantastic job with the renovations on the model. You can see it's missing a backsplash in the kitchen, which will really help it pop. But otherwise, you've got the new luxury vinyl plank flooring, upgraded appliances, new cabinet fronts with the pulls, faucet fixtures, hard surface countertops. So it looks really good. You've got the framed mirrors in the bathroom. So the transformation will really bring a lot of value to the property.
Yeah, I mean, it's a huge difference. So, and then here's a look at some more finished unit.
Yep.
Images here, right?
Yep. And this is an example of, I mean, we don't have to spend any time on that, but that's an example of the the lofted den style or the townhome style 1-bedroom. So you can see the 1-bedroom in the bottom left picture. It's got that open
Right there.
open floor plan, which I like a lot.
Yeah. Yeah. Looks really nice.
And it even has its own balcony. So that's cool.
All right. And talk to us about what your plan is for the exterior.
Yeah. So as mentioned before, this property is in great shape for a 1983 vintage property, and it has all the construction type things that we look for. So it doesn't have any red flags like aluminum wiring or a flat roof or foundation issues. So everything is in order. The roofs are in good shape. The siding is in good shape. It's in my opinion a very attractive brick exterior. So there's really not too much going on the exterior as far as deferred maintenance. However, if we go to the next slide on the amenities, there is some deferred maintenance on the amenities. The pool, believe it or not, is not in service, nor is the hot tub. And you'll see in the next couple pictures here that will spool up there, that pool in the bottom right picture, bottom middle right rather.
Yeah.
We have a green hot tub, which we need to get back in service right away, because that really hurts leasing if we're showing prospective residents a pool that nobody can use and a hot tub that's green. So that's some of the small deferred maintenance items. And then on the other phase, the property's built in 2 phases. There's another pool, not pictured here, and then that pool is missing a summer kitchen. You can see the nice summer kitchen in the main picture as well as in the bottom left. So we'll be building one of those out on phase 2 as well.
Okay, great. And looking now at the unit mix, you've got a great mix of 1-bedrooms with the den, and then some 2-2s, and your average rent per square foot right now is $1.24 dollars per unit, and you have pro forma out at 1.43. And then looking at the consolidated unit mix here, 1-bedroom is 1.26 currently. You're going to push that to 1.45. 1-bedroom with the den is 1.18, and you're going to push that to 1.39, and then 2-bedroom is 1.27, and you're going to push it to 1.44.
The only thing I wanted to add there, we kind of highlighted at the very beginning, but we were covering a lot of things. The rent growth in this market has been fantastic. The last 12 months has been 14%, and actually the next 12 months is projected to be in the double digits as well. So theoretically, if you believe the market projections, which obviously we're not forecasting that into our model, we're just assuming 3% annual growth. But if we were to forecast that, we could essentially achieve our pro forma rents without spending a dollar and doing our business plan, because there's so much growth here that's embedded in the market.
Right. So what you're saying is just from organic growth, without doing anything, you will achieve the pro forma cost per square foot.
Assuming that the projections are correct, which of course we're not baking that into our underwriting.
Yeah. Okay. All right, let's jump into West Houston submarket.
Yeah, so we really like the Briar Forest submarket, and particularly where Broadstone sits. It's in a very residential location with, again, the schools nearby and a lot of high value single family homes and newer, nicer multifamily product as well, which is really proving that headline growth opportunity. And I think part of the reason why it's such an attractive place is you've got that residential feel with the open streets and the trees, but you're also very proximate to major roadways that get you everywhere you need to go in Houston. I mean, I think within a 3-mile radius, we have 65,000 jobs. So it's a tremendous job hub, but you're not necessarily in it. So it's that perfect balance. And the thing that we really like about Broadstone is that we're not necessarily competing with all the newer, nicer product. We're that ugly house on the really nice block, which is perfectly positioned for us because we like to be that affordable option in the workforce housing segment.
Right. And with your value add, you can force appreciation, and that market supports, those rental rates.
Right. And we'll still remain $300 below the top tier product in the market.
Awesome. So more on the submarket, it's near major employment centers, as you mentioned. It's centrally positioned between Briar Forest Drive, Eldridge Parkway, Westheimer Road, and Dairy Ashford Road. So residents have direct access to Highway 6, Interstate 10, the Sam Houston Tollway, Beltway 8, and West Park Tollway, and have multiple commute options to Houston's largest employment districts. You mentioned this, but there's 6,000 businesses with 65,000 employees in a 3-mile radius. It's a half a mile north of Westheimer, which is a key local business corridor paralleling I-10 and West Park Tollway, westbound from downtown Houston, with extensive retail like Target, Trader Joe's, Walmart, etc. So if you're shopping at Trader Joe's, you probably have a few bucks. It's the largest business sectors in the area are healthcare and social assistance, scientific and technology services, retail and financial and finance and insurance. There is a Cisco corporate headquarters, which is about 1.1 miles away from Broadstone. And as we've mentioned before, there's a village school, which is a $33,000 a year boarding or day school, which is 1 block from Broadstone. Here's some great images of the area. Also of note is that it is right next to a huge outdoor recreation area, the George Bush Park, which just adds to what a great area it is for families and active people. So here's a high level view of a map of the site. So you have Broadstone here. Again, great home values all the way around it. It's really residential, great location. Here we got a map showing all the retail and businesses. So you got Trader Joe's down the street, Target, Cisco headquarters, a country club, and then that big outdoor recreation area, the George Bush Park. And then finally, a high level on its proximity to Houston. So lots of different options in terms of commute to Houston if you needed to do that. And so let's get into the investment analysis now and the numbers of this, right? So can you talk to us a little bit about the comps? Here, Rob.
Yep. So there's certainly a lot of good comps that we've been discussing that prove out the upside. And I think we were pretty thoughtful with our selection of rent comps to make sure that we're including properties that are similar in vintage, also newer in vintage, to prove out the renovation upside, and then also keep that discount, as we can be the renovated product but still be the discounted product to the top tier product. So you can see in this picture here, the rent comps that we've chosen are truly comparables. They're right nearby in the same neighborhood with the same economic drivers.
Mm-hmm. All right, so here's some high level on the comps. So average comps on the one bedrooms right now are 1.46. Broadstone is at 1.26 currently. On the 1 bedroom with the den, average among the comps is 1.4, and Broadstone is well below that at 1.18. And then interesting here, the 2 bedroom, 2 bath average is 1.33, and Broadstone is currently 1.27. And you have a pro forma out at 1.44. So the question when I see this is why you think you can get a premium on the 2.2s above the average rent comps.
Yeah, that's because the 2 bedrooms at Broadstone are slightly smaller than the majority of the comp set. So that's why it's going to look a little bit higher on a per foot basis, but on a dollar basis, on a gross dollar basis, it's makes sense in the market.
Okay, awesome. So maybe you can give us some color on the sales comps here.
Yeah, so the sales comps again are some newer, some on par as far as the vintage, some renovated, some unrenovated. And you can see that there are properties trading for a substantial premium to where our entry price on Broadstone. So we do feel very good about our per unit basis on Broadstone when you compare it to the comps, as well as when you compare it to the single family home product in the vicinity. And when you layer on top of our going in cap rate of 4.4%, given all the embedded upside, I think the basis is very compelling.
Yeah. And so, it's clear that it's below average at acquisitions. So what factors do you think contributed to you being able to get this? Is it hanging around the hoop, or like
Yeah,
how did you get such a good deal?
yeah. So what we're seeing is, I mean, obviously deals just always have their unique features, but one thing that you can, in this market that we're in right now, one thing you can really bet on is the fact that deals that make it through a best and final process more often than not, uh, go through multiple rounds of bidding and end up going anywhere from 5 to 25% over asking price, just depending on the process, the desirability of the product, and the market. So we were able to shelter this acquisition from any sort of public bidding process.
Mhm.
And so the sellers had an expectation of value, and we were able to meet that value after some small negotiations.
Mhm.
And we kept the deal away from getting fully exposed to a full process.
Yeah. Okay, great. Thanks. That makes sense. Thanks for sharing. And so here we have the pro forma financials. Rob, as the publisher of the #1 definitive guide to underwriting multifamily acquisitions, what stands out to you here?
Yeah. So the thing that I would like to point out is the year one revenue versus T12. You can see that our business plan, like we projected, is to take place over 24 months. So in year one, we're only assuming a 5% increase off of T12, right? And this is, of course, after doing a lot of work and renovations and pushing the other income. And of course, the market's projecting over 10% rent growth organically. So we could see 10% rent growth before even doing our business plan, but all we're projecting is 5% in year one, which I think is reasonable. And then moving on to year two, you see that's where we start to get a nice big bulk of our gains from our business plan, going from year one to year two, a 12% increase. And then finally finishing it out into year three with another 8% growth. So I think our overall lift is conservatively projected, and then the time that we're projecting is also conservative. And then nothing really too fancy on the expense side. We're just using our market knowledge of owning property in the market, and our management team, as well as our consultants for insurance and property taxes, to derive the expense pro forma.
Gotcha. Okay. Anything else that we should note here?
Nope.
Okay. All right. Why don't you briefly walk us through the CapEx budget? We've touched on a lot of it already, but so if you want to just go high level.
This is just a look if anybody wants to pause and take a deeper dive. This is just an itemized breakdown of the budget. This budget has been scoped by our general contractor partners, our internal property management and asset management teams, and we feel very good about the price, or about the cost of everything. And historically, we've hit or come in under budget on these budgets.
Yeah. Okay. Awesome. I want to be conscious of your time because I know you got another call to jump on here. But can you speak to your general contractor or your construction team and your experience with them?
Yeah. So our construction is overseen by our VP of operations, Aaron Petrie. He sits in Houston. He runs our portfolio, and we've been with him since inception. So back in 2018, and he's overseen, multiple millions of dollars of construction budgets with us. And we work very closely also with TPI, which is a family-owned GC local in Houston that we do a lot of work with as well.
Okay. So you have experience with them over the years. Awesome. And then you ran some sensitivity analysis here.
Yeah, and also to note, this is my mistake, but these sensitivity analyses are done based on the Class A returns, which JKAM investors are participating as a Class B investor, and therefore getting preferential returns. So the returns here, although sensitized, are just generally slightly better than what's projected here.
Yeah.
But you can see our base case assumptions are derived using a 5% exit cap rate, which in my opinion is extremely conservative for the market. These types of properties that we're seeing day in, day out in Houston are trading for kind of mid threes to low fours. So I think we got a great deal at a 4.4 cap. And we could have easily projected defensively to exit at a 4 3/4, but we just chose to do 5% because the numbers could support it. So you can see the upside there. Of course, if the market continues to perform well, and we could sell for a 4.5 cap. But then conversely, the thing to note is just because the market softens, if it does, and goes to, let's say, 5 3/4 cap, which would be a major change in the market, it doesn't necessarily mean we have to sell, right? We're fortunate to be able to live on the cash flow, and cash flow is number one, not just as a source of returns, but also as a source of risk mitigation. So for us, we see this downside scenario as number one, unlikely, but also one in which we can navigate through and live to fight another day, essentially, and then sell at a more opportune time.
Yeah, makes sense. Everyone is talking about interest rates and inflation. Can you speak to how those factors could impact this project and how you've underwritten with those factors in mind? I mean, beyond the conservative terminal cap rate.
So as we mentioned before, we have the interest rate forward curve baked in. So to the extent that we have interest rate risk and we have floating rate debt, we are projecting that cost of debt to rise over time as the Fed is projected to raise rates. So our cash flow is accounting for that. And also, I think just macroeconomically speaking, this segment of the market, it has been responding well to inflation. Rents have been growing, on pace or faster than inflation. So on a net basis, even if your expenses are growing at the same rate, because your revenue is twice as large as your expenses, you're still coming out ahead.
Yeah. Okay. Awesome. Thanks for sharing. That's a pretty common question that we're seeing these days. So, and then you did a sensitivity analysis on cash flow sensitivity as well. So you touched on that on the last slide. So we'll just go ahead and jump through this and get to a conclusion here. So this deal is live to investors and available right now. If you want to take a look in our data room, funding deadline for this is March 25th, and with a target closing on April 12th. Thank you again for joining us today, Rob, and sharing this opportunity with us. If you guys have any questions, comments, or feedback, we'd welcome hearing from you. To access more detailed information on this, you want to dig into the pro forma, you want to dig into the CoStar comps, all that information is available to you in the data room here. And there's a short link for that. That's bit.ly/Broadstone data. And that'll wrap it up for today. Rob, thanks again for joining us. I really appreciate your time. And we'll see all of you guys next time.
No problem. Thanks a lot.
All right. See ya.